All right, let's kick off another deep dive. You sent us some economics course materials, and gotta say, this study guide looks pretty intense.
Yeah, it can be a bit
But
much.
no worries, that's what we're here for. We'll break it all down in a way that actually makes sense. Make it fun.
Definitely. Economics can seem like it's all jargon and formulas, but really it's about understanding how people make decisions and what happens when all those decisions kind of bump up against each other.
Exactly. So shall we jump right in?
Let's do it.
Awesome. Okay, so the first unit here is all about measuring macroeconomic performance. Sounds pretty fundamental.
It is, yeah. It's like the starting point for figuring out how economists track, how an economy is doing overall.
Gotcha. And right off the bat, they hit us with gross domestic product, GDP. Everyone's always talking about GDP, right?
Oh, yeah, it's definitely one of the most important numbers in macroeconomics. Basically, GDP measures the total value of everything produced in a country, over a certain period of time, usually a year.
Okay, so it's like a snapshot of the economy's output, right?
Exactly.
But then this study guide gets even more specific, talking about the value-added approach to calculating GDP. They use a car manufacturer as an example, saying how the value of the steel used to make the car is already included in the final price of the car.
Right, that's important because you don't want to be counting things twice. Like the steel gets counted when it's sold to the car maker, and then again when the car's sold. We only want the value that's added at each step.
Ah, okay, that makes sense. So we need to kind of isolate the value added at each stage to get an accurate picture of the total output. This study guide really emphasizes that point. They say we need to understand GDP by looking at the flow of goods and services, and they're going to be testing that on the exam.
Yeah, it's all about tracking how things move through the economy from production to consumption. Economists use that to figure out where the action is, how different sectors contribute, the whole picture of how the economy is performing.
Speaking of how the economy is performing, there's this whole thing about nominal and real GDP. What's the difference there, and why does it matter?
It's a really crucial distinction, especially if we're looking at how things change over time. See, nominal GDP, that just uses the current prices. But real GDP that adjusts for inflation, uses a fixed set of prices from some base year.
Okay, so like if prices are going up, nominal GDP might make it look like the economy's booming, even if we're not actually producing more stuff. Real GDP helps us see past that, right?
Exactly. It's like looking through, I don't know, like a funhouse mirror. You need real GDP to see if things are actually growing or just getting more expensive. And get this, the study guide says this isn't just for economists. This stuff can help anyone understand economic data.
Okay, so that's GDP in a nutshell. Got it. Now, another big concept in this unit is the consumption function. Seems pretty important, huh?
It is, yeah, the consumption function. It basically describes the relationship between how much money people have, their disposable income, and how much they spend. It's a fundamental part of a lot of macroeconomic models.
Right, and then they introduce this equation, C equals C0 plus CYD. Looks a bit intimidating at first glance.
Yeah, but it's not as scary as it looks. C is just consumption spending, YD is disposable income, C0 is what they call autonomous consumption, and then C is the marginal propensity to consume.
Okay, so autonomous consumption, that's the amount someone would spend even if they had no income, like basic survival spending. And MPC, that tells us how much of every extra dollar gets spent.
Exactly. Like if your MPC is zero point 0.8, for every extra buck you get, you're spending 80 cents, saving 20. This unit is all about understanding the consumption function every which way. Words, graphs, math, you name it.
Right, so we can see how changes in income affect spending and ultimately the whole economy.
Precisely. And that actually brings us to another concept, the multiplier effect. This is about how a change in spending, like, ripples through the economy, leading to an even bigger change in GDP.
Oh, that's interesting. So how does that work? The study guide talks about government spending as an example.
Okay, so let's say the government spends, I don't know, $100 million on a new bridge. That money becomes income for the construction workers, the suppliers, everyone involved, right?
Makes sense.
They then spend some of that new income on other stuff, which then creates more income for others, and so on and so on.
Like a chain reaction. So the initial spending kind of multiplies as it goes around the economy. But how do we actually calculate that? The study guide really hammers home that we need to understand and use the multiplier concept and how it affects GDP. There's even an example where they assume the MPC is zero point 0.8.
Right, so the size of that multiplier, it depends on the MPC. If the MPC is zero point 0.8, like you said, 80% of every extra dollar gets spent. So that initial $100 million, that could actually lead to a $500 million increase in GDP.
Wow, that's a pretty big impact. So even small changes can have a big effect on the whole economy.
Exactly. And this actually shows us how powerful fiscal policy can be, something we can dive into later.
This is all starting to click now, but wait a minute. This study guide throws in a curveball, the paradox of thrift. How can saving be a bad thing?
It's not always bad. The paradox of thrift is about what happens when, like, everyone tries to save more at the same time.
Okay, now that sounds interesting. Tell me more. The study guide says we need to understand how that affects the economy, especially in the short run. And we got to be able to explain it with words and diagrams.
So if everyone suddenly starts saving more, that means they're spending less. Right, and that drop in spending, that can lead to lower demand and then maybe even a recession.
Ah, okay, so everyone's trying to save more, but then because the economy shrinks, they end up saving less overall.
Exactly. It's kind of self-defeating.
Makes you think, huh?
It does, and it shows how all these individual decisions can really affect the big picture.
All right, fascinating stuff. Ready to move on?
Yeah, let's go.
Okay, so next up we've got money, banking, and monetary policy. Feels especially relevant right now, with everything going on in the economy.
It definitely is. This unit is all about the financial system, how money's created, and how central banks try to influence things.
Right, so first things first. This is money, exactly. I mean, we all use it, but what does it actually do? This study guide's got a whole section on that. They want us to know what money is and all its different functions.
Money is basically anything that's widely accepted as payment, right? It's got to be something we can use to measure value and store value for the future.
Okay, so money is how we keep the whole economy running smoothly. Makes sense.
Yeah, it's essential for a modern economy.
But how is money actually created? This study guide goes into something called the fractional reserve banking system. Sounds kind of complicated.
It's the key to how it all works. Basically, banks don't keep all the money you deposit, just a fraction of it, and they lend out the rest. And that lending and relending, that's how new money comes into being.
So like if I deposit $100 and the bank only has to keep, say, 10%, they can lend out $90. And then that $90 becomes someone else's deposit and they borrow part of that and it just keeps going.
Exactly, like a money multiplier. Each round of lending creates more money. But this system, it's kind of delicate. If everyone tries to withdraw their money at the same time, banks can run into trouble.
Right, like a bank run like we saw during the financial crisis. Scary stuff.
Yeah, it can get pretty messy. That's why we have central banks, to regulate things, keep the system stable. This study guide mentions a bunch of things central banks do, like being a lender of last resort, setting these reserve requirements, and of course doing monetary policy.
Right, so central banks are kind of like the referees, keeping things fair and making sure no one's cheating.
Exactly. They make sure the game is played properly.
Okay, but how do they actually influence the economy through this monetary policy thing?
They have a few tools, but the big one is interest rates. By raising or lowering rates, they can affect how much it costs to borrow, which changes spending decisions, and then that influences inflation and economic growth.
Okay, so if the central bank wants to boost the economy, they can lower rates so it's cheaper for people and businesses to borrow and spend.
Exactly. Lower rates encourage investment and spending, which can give the economy a jump start. But if things are getting too hot, they can raise rates to cool things down a bit.
Makes sense. But what if rates are already super low, like they've been recently? The study guide talks about something called a liquidity trap, where, the usual tools don't work so well anymore.
Right. A liquidity trap, it happens when rates are basically zero, and people would rather hold onto their cash than invest or spend, even if borrowing is super cheap.
So even if the central bank pumps more money into the system, it doesn't really get things moving because everyone's just hoarding cash.
Exactly. It's a tough situation for policymakers.
Sounds like it. How do they even deal with that?
It gets tricky. They might try some unconventional things like quantitative easing, where they buy assets directly to, inject liquidity into the system. But those things can have side effects, and there's a lot of debate about how well they actually work.
Wow, this is way more complicated than I thought. The whole financial system, I mean.
Yeah, it's a fascinating system, but super complex, and it really affects the whole economy.
All right, I think that's a good place to take a break, right?
Sounds good to me. We've covered a lot already, from GDP and the consumption function to all this crazy stuff about money and banking.
Lots to digest. But we're just getting started. We'll be back soon to dive into labor markets, open economies, and how governments try to steer the ship. See you then.
Can't wait. All right, welcome back to our deep dive. Ready for more?
Absolutely. Let's pick up where we left off. We were about to get into labor markets, right? This unit, labor markets and unemployment, seems pretty timely, with all the talk about jobs and unemployment rates these days.
Yeah, it's a hot topic for sure. This unit really digs into how the labor market works, how wages are set and all the things that contribute to unemployment.
Okay, so let's start with the basics. How do economists even measure unemployment? And what are all these different types of unemployment? This document's really emphasizing that we need to know how that unemployment rate is calculated.
Right. So the unemployment rate, it's basically the percentage of people who are actively looking for work but can't find a job. It's a key indicator of how the labor market's doing and the overall economy, too.
Right. Makes sense. And this study guide mentions a bunch of different types of unemployment, like frictional, structural, cyclical. What's the difference? It even says we should be able to explain all the different types.
Okay, so frictional unemployment, that's the kind that's just, part of the normal churn of the economy. People moving between jobs, searching for new opportunities. It's always going to be there to some extent.
So it's kind of like the time it takes to find the right job match. Yeah, I can see how that's unavoidable. What about structural unemployment? The study guy's talking about a skills mismatch there.
Right, so structural unemployment, that happens when, the skills that workers have, they don't match up with the skills employers need. This can happen because of technology, changes in what people want to buy, or even globalization, like jobs get lost in one industry, but new ones are created in another.
Ah, okay. So it's like trying to fit the wrong pieces into a puzzle. Seems like that kind of unemployment needs a longer-term solution, right? Like retraining programs in education.
Exactly. You got to bridge that skills gap somehow. And then there's cyclical unemployment, which is tied to, the ups and downs of the business cycle. During recessions, demand for labor goes down, businesses lay people off.
So cyclical unemployment's like catching an economic cold. It comes and goes with the business cycle.
That's a good way to put it. And policymakers often try to deal with that using fiscal and monetary policy, try to stimulate demand and get people back to work.
This is all starting to make sense. Now, this study guide also gets into the whole wage thing, talking about efficiency wage theory and the role of bargaining power. It even says the wage level can actually affect how productive workers are.
Right, those are big concepts in labor economics. Efficiency wage theory, it's kind of counterintuitive, but it basically says that paying higher wages can actually benefit employers. Higher productivity, less turnover, attract better talent.
So it's like investing in your employees. Makes sense in the long run, I guess.
Exactly. It's not just about squeezing every penny. And then you've got bargaining power, which also plays a huge role in wage determination. Strong unions, high demand for certain skills, low unemployment, all that gives workers more leverage to negotiate higher wages.
So it's kind of like a tug of war, huh? Employers versus employees, and wages are the prize in the middle.
Yeah, that's a good analogy. And the power balance can shift depending on all sorts of things like the economy, government regulations, the whole works.
Okay, so we've got these different forces at play with wages. But what about this natural rate of unemployment? Seems kind of weird to talk about a natural level of unemployment. Shouldn't we be aiming for zero?
Yeah, the natural rate, it's a bit of a misleading term. It doesn't mean that level of unemployment is, good or inevitable. It's more like a theoretical benchmark that economists use. It's the unemployment rate when the economy's doing, as well as it can, given things like frictional and structural unemployment, which are always going to be there to some extent.
So it's kind of like the baseline level, even in a good economy.
Exactly. And this unit connects the natural rate to the Phillips curve. Remember that?
Oh yeah, the Phillips curve, we touched on that earlier. Isn't that about a trade-off between inflation and unemployment?
Yeah, that was the original idea, but the relationship between those two have gotten a lot more complicated over time. The Phillips curve's not as reliable as it used to be.
So it's not as simple as picking a point on a graph and getting your perfect economic outcome.
Nope, economics is rarely that simple. Inflation and unemployment, they're affected by all kinds of things: expectations, supply shocks, changes in how the economy's structured, you name it.
Wow, this is making me rethink the whole labor market thing. Way more to it than I realized.
It's a complex system for sure, but super important. Affect everyone, individuals, businesses, policymakers, the whole lot.
Okay, ready to move on to the next unit? This one's open economy, macroeconomics. Seems pretty relevant these days, with globalization and everything.
Definitely. This unit's all about how economies interact with each other, through trade, finance, exchange rates. It adds a whole other layer of complexity.
All right, let's dive in. What are the big ideas here? This study guide says it's really important to understand how exchange rates affect imports and exports, and that'll be on the exam.
Okay, so one of the most important concepts is the exchange rate, right? It basically tells you how much one currency is worth compared to another. And when those rates change, it affects the prices of goods and services across countries, which then affects trade and competitiveness.
Right, and this document uses the South African rand and the US dollar as an example, showing how changes in the exchange rate can impact trade. Like, if the rand weakens against the dollar, South African goods become cheaper for US buyers, so exports go up, and US goods get more expensive in South Africa, so imports go down.
Exactly. It's like a seesaw. The exchange rate shifts, and the balance of trade tilts one way or the other.
But wait, there's also this thing called the real exchange rate. What's the difference between that and the regular exchange rate?
Good question. The nominal exchange rate, that's just how many units of one currency you can trade for another. The real exchange rate takes into account the prices of goods and services in those countries, too. So it gives you a better idea of the actual purchasing power of each currency.
Ah, okay. So the real exchange rate tells you how much stuff you can actually buy in one country versus another, not just the raw numbers.
Exactly. It's a more nuanced measure of how currencies are really valued and how that affects trade.
All right, so we've got exchange rates affecting trade. But what about the financial side of things? This study guide mentions the interest parity condition and arbitrage, now in the context of open economies.
Right, those are key concepts for understanding how international finance works and how exchange rates get determined in a globalized world. The interest parity condition, it basically says that differences in interest rates between countries should be reflected in the exchange rate.
So like, if one country has higher interest rates, investors might want to move their money there, pushing up the demand for that currency and causing its exchange rate to appreciate.
Exactly, and that's where arbitrage comes in. Arbitrageurs, they're always looking for opportunities to make money from these differences in interest rates. They buy and sell currencies to take advantage of any discrepancies, and that helps keep exchange rates in line with the underlying economic conditions.
Man, it's like this high-stakes global finance game.
Kind of. It's constantly moving, always changing.
This standard also talks about some of the challenges that come with having an open economy, like trade balances and problems with, having a trade deficit for too long.
Yeah, that's a big issue. If a country is consistently importing more than it's exporting, that's a trade deficit. And that can have all sorts of consequences.
Right, and this document goes into detail about the importance of understanding a country's trade balance, especially if they're in a deficit or a surplus. They say we should understand the implications. So like, a trade deficit can drain a country's foreign reserves, put pressure on its currency to weaken, and maybe even lead to job losses in certain industries.
Exactly. It's a balancing act for policymakers. They got to figure out how to promote exports, attract foreign investment, and keep everything stable.
This is really making me see how connected the world economy is. What happens in one place can ripple out and affect everyone else.
Absolutely. Globalization, right, it's a double-edged sword.
Okay, so we've talked about labor markets and open economies. What's next?
Well, this study guide wraps things up with a unit called Macroeconomic Policy Challenges. It's all about the tools governments and central banks have to try and steer the economy and all the dilemmas that come with that.
Okay, sounds interesting. I'm curious about the different types of policies and how they're used to deal with different problems.
One of the key distinctions is between fiscal policy and monetary policy. Fiscal policy is all about government spending and taxes, while monetary policy focuses on interest rates and the money supply. The document emphasizes that we should understand the differences between the two.
Right, we talked about monetary policy with central banks earlier, but what about this fiscal policy thing? How does that work? This unit's really hammering home the need to understand the effects of fiscal policy, both on the demand side and the supply side, and they want us to use graphs to explain it all.
So fiscal policy, it's a powerful tool that governments can use to influence, overall demand, employment, inflation. During a recession, when things are slow, governments can spend more or cut taxes to try and boost demand and create jobs. That's called expansionary fiscal policy.
So it's like giving the economy a shot of adrenaline.
Yeah, that's a good way to put it. And then on the flip side, if things are getting too hot, inflation's rising, they can cut spending or raise taxes to slow things down. That's contractionary fiscal policy.
Sounds like a balancing act, Too much stimulus and you get inflation, too much austerity and you stifle growth.
Exactly. Getting that balance right is tricky. Policymakers have to be really careful about the timing, the size, and the types of fiscal measures they use.
This study guide also mentions the multiplier effect, again, now in the context of fiscal policy. How does that fit in?
The multiplier effect, it's key to understanding how fiscal policy really works. Because a change in government spending or taxes, it doesn't just affect that one thing, it ripples through the economy, leading to a much bigger change in GDP.
So it's like a domino effect, right? One small push can set off a whole chain reaction. This study guide even uses that example again, where the MPC is 0.8.
Right, so if the government spends an extra $100 million and the MPC is 0.8, 80% of each extra dollar gets spent, remember? So that $100 million could actually lead to a $500 million boost to GDP.
Wow, so those spending decisions really have a big impact. Policymakers got to understand this multiplier effect, right?
Absolutely. It shows you how powerful fiscal policy can be, whether you're trying to stimulate the economy or slow it down.
This is really eye-opening. Economic policymaking, it's a lot more complicated than I thought. So many things to consider, so many ways things can go wrong.
Yeah, it's not easy. Policymakers are dealing with all sorts of challenges, trying to manage the business cycle, keep inflation in check, promote sustainable growth. It's a lot. And they have to make tough choices that affect everyone.
This study guide also talks about how, policies don't always work the way you expect, and they can take time to have an effect. Talks about time lags, uncertainty, and unintended consequences.
Right, those are important limitations. Policies can backfire, and it's not always easy to predict what will happen. Policymakers have to be aware of that and be ready to adapt.
Sounds like they need to be economists, strategists, and maybe even have a crystal ball.
Yeah, it's a tough job, but super important. Their decisions affect everyone. Jobs, incomes, prices, the whole shebang.
Okay, ready for the next section. This one's about the role of government in the economy. Now, that's a topic that always gets people talking. What are the main viewpoints here? This study guide says we need to understand different arguments for and against government intervention in the economy.
Yeah, there's a whole spectrum of opinions on that, but one of the big divides is between those who favor a hands-off approach, let the market do its thing, and those who think the government needs to be more active in shaping things.
Right, and the study guide specifically mentions things like providing public goods and addressing market failures. Why are those seen as good reasons for government intervention?
Well, public goods, those are things that everyone benefits from, whether they pay for them or not, like national defense, clean air, public parks. One person using them doesn't take away from anyone else's enjoyment, and it's hard to exclude people from benefiting, even if they don't pay.
So because of that, private businesses probably wouldn't provide those things very efficiently, right? It's not very profitable. So the government steps in.
Exactly. The government can provide those goods and pay for them through taxes, making sure everyone benefits.
Okay, that makes sense. What about these market failures?
Market failures, they happen when, markets don't allocate resources in a way that's best for society as a whole. Like, think about pollution. That's an externality, a cost that spills over onto people who aren't even involved in the activity. Or monopolies, where one company controls everything and can jack up prices.
So it's like the market's invisible hand sometimes drops the ball.
Yeah, good analogy. And that's when the government can step in, regulate things, impose taxes, provide subsidies, or even take over providing those goods or services themselves.
Okay, I'm seeing how government intervention can sometimes make things better, fix the market's mistakes. This document highlights how government spending on infrastructure can improve a country's economic output, for example.
Absolutely. But it's not a magic bullet. Government intervention can also have unintended consequences, distort things, or even be inefficient if it's not done carefully.
Right, it's a trade-off, isn't it? Policymakers have to weigh the potential benefits against the potential risks. They got to be good economists, understand how markets work, but also where they might go wrong.
Exactly. It's about finding the right balance between letting the market do its thing and stepping in when needed.
Okay, so we've talked about public goods, market failures, and government policies. What else do we need to consider about the government's role?
Well, this study guide also talks about the government's budget constraint. Basically, they can't just spend money without consequences. They have to raise money through taxes or borrowing.
Right, makes sense. This document goes into budget deficits and national debt. They say we need to be able to explain what happens when the government runs a deficit. So like if they keep spending more than they're bringing in, they go into debt. And that can lead to higher interest payments, crowd out private investment, and maybe even destabilize the financial system, right?
Exactly. Being responsible with government finances, that's super important for the long-term health of the economy.
This deep dive has really changed how I think about economics. It's not just about numbers and graphs. It's about people and how we make decisions as individuals and as a society. And it's about understanding the complex relationship between markets and governments.
That's a great way to put it. Economics is ultimately about people and their well-being.
Okay, before we move on, one more thing from the study guide that caught my eye. It talks about the potential conflict between short-term and long-term economic goals. How do policymakers deal with that?
That's a constant struggle. Policymakers often have to choose between, boosting the economy now or doing things that will be beneficial in the long run, like keeping debt under control, promoting innovation, or tackling climate change.
So like trying to juggle multiple balls at once without dropping any of them. This study guide is stressing that we need to be able to discuss those trade-offs and how different policies can address them.
Exactly. Sometimes what's good in the short term can be bad in the long term and vice versa, like running big deficits to stimulate the economy. That might help now, but could lead to problems down the road if the debt gets too high.
So it's all about finding that balance again, right? Thinking about the future, not just the present. Making tough choices today to create a better tomorrow.
Well said. Sustainable economic progress, it means thinking about both the present and the future.
This has been an amazing deep dive. I feel like I'm starting to see the world through an economic lens now, thinking about trade-offs, incentives, unintended consequences.
That's fantastic. The more we understand about economics, the better choices we can make, both personally and as citizens.
All right, I think that wraps up part 2. We've covered a lot of ground, from labor markets to the role of government and all the challenges that come with managing an economy.
It's been a great discussion, and we've seen how all these different pieces of the economic puzzle fit together.
And we did it without getting lost in the jargon. I'm actually excited to learn more about economics now.
Me too. There's always more to discover. And remember, economics is all around us. It's in everything we do.
Welcome back for our final deep dive into these economics materials. We've learned a ton already, from GDP to all the ins and outs of monetary policy.
It's been a whirlwind tour of economics.
It has. Now, for this last part, I'm really curious about this idea of economic growth and development. It's a whole section in this study guide. It Seems like a pretty big topic.
It's huge, but it's also super important. Understanding how economies grow and develop, that's key to improving living standards, reducing poverty, creating opportunities for people.
Right, and they make a point of saying that economic growth and economic development, those aren't the same thing.
Yeah, are related, but definitely not identical. Economic growth, that's usually measured by how much a country's GDP increases over time. But development, that's a bigger picture kind of thing. It includes things like education, health, infrastructure, how income is distributed.
So growth is like the numbers, the hard data, and development is more about like how that translates into a better quality of life for people. This study guide's saying we got to understand the difference, how each one's measured.
Yeah, that's a good way to think about it. Growth is important, but it's not enough on its own. A country can grow its GDP without really improving people's lives.
Okay, that makes sense. So what are the big things that drive both growth and development? The study guide mentions capital accumulation, technological progress, human capital, and institutional quality.
Those are the key ingredients. Investing in physical capital, things like factories, machines, infrastructure, that helps boost productivity. Human capital, that's education, skills, health, all that's crucial for innovation and keeping up with changes. Technological progress, well, that's about finding new and better ways to do things, which obviously helps increase output. And then there's the institutional framework, things like property rights, a fair legal system, a stable government. That's the foundation that allows everything else to work.
So it's like a recipe. You got to have all the right ingredients and the right amounts.
Exactly. And this unit really stresses that there's no single formula for success. What works for one country might not work for another. Every country has its own unique set of challenges and opportunities.
So policymakers can't just copy-paste policies from somewhere else. They have to figure out what works best for their own situation. The study guide says we should be able to evaluate different growth models and policies.
Right, and they have to think long-term, too. Balance the needs of today with the needs of the future. Make sure that growth is sustainable and benefits everyone, not just a select few.
This deep dive has been amazing. I feel like I have a much better grasp on this economics stuff now. And not just for the course, but like I can see how it applies to the real world.
That's great to hear. Economics, it's not just a bunch of theories. It's a way of understanding how the world works.
Totally. I actually kind of excited to keep learning about it.
Me too. It's a lifelong journey.
Well, I think that brings us to the end of our economic adventure. We've covered a ton from GDP to labor markets, globalization, the role of government, all that good stuff.
It's been a blast.
It has. Thanks for joining us on this deep dive, everyone. Hope you enjoyed it and maybe learned a thing or two along the way.
Absolutely. Economics is everywhere. It's in the choices we make, the businesses we interact with, the policies that shape our lives. So keep exploring, keep asking questions, keep learning.